Hello and welcome everybody, I'm Stephen and I'm a popular investor on eToro. Thanks for listening to this video today, and as usual don't forget to like this video and subscribe to my channel. I'll really appreciate it. So in today's video I'm going to be talking about what happened in the markets last week, and I'm also going to be explaining a bit about how our portfolio fared overall. So to get right into it, last week was a difficult week again in the markets, and it was actually the fifth straight week consecutive loss for the major indexes. So again, it was a very tough week like we have seen throughout 2022. And there are lots of different reasons why the indexes were down last week, and one of the main reasons was around the Fed meeting which happened in the US. And the main thing that happened in that Fed meeting was that they decided to do a 50 basis point hike. This was actually seen as a reasonably good thing at the time when they made this 50 basis point hike, because a lot of people had been expecting, and there had been some anticipation from analysts and from normal investors that they could increase this all the way to 75 basis points. And in that meeting that happened with the Fed on Tuesday and Wednesday, there was a speech by Jerome Powell shortly after that meeting, in which he said that it was highly unlikely that they were going to look at a 75 basis point hike in the near future. So this obviously speculated that there's going to be much more likely in the future to continue with these 50 basis point hikes. In that meeting as well, we also saw that they plan to cut back on the buys of mortgage-backed securities and also treasury bonds. And in that, they have decided that they are going to reduce by at a pace of 47.5 billion straight away. And then after that, over the next 3 months, they then plan to reduce the pace of the buys by 97.5 billion. So what we are really seeing is that they are reducing and cutting back some of that debt that they have on the balance sheet, and they're really trying to tighten during this cycle. So what we are really seeing is quantitative tightening, and this is the opposite to quantitative easing. And over 2020 and over 2021, when we were in the midst of the pandemic, there was a lot of stimulus provided in the economy. The governments were buying a large amounts of mortgage-backed securities and buying treasury bonds. And it now is a period where, because inflation is so high, that they are starting to cut back on all of this and started to do something called quantitative tightening. And that is by increasing the interest rates and then also reducing that balance sheet that the US has. This encourages people to cut back their spending, which hopefully should have a positive effect on the inflation and help to reduce some of that inflation that we are seeing heavily in our economy recently. However, this is at a detriment to growth in the economy as well. So the Fed really needs to find this balance between tackling inflation and also not stalling the economy and making it go into a recession. So really what I can see over the next couple of months is I think that they will continue to increase these interest rates as have been scheduled. And then I think what will happen is I think that there will be something that breaks in between. Doesn't necessarily mean a recession or anything really severe in the stock market, but something will force the Federal Reserve in the end to slow down increasing the interest rates. And I think then they will go round with another round of quantitative easing. But I think they have to, at the moment, try to curb some of that inflation and fight it as well as they can in that short term. And then when it's clear that they cannot do that any longer, they will not want to damage the overall economy. And I think that we will then see the interest rate hikes beginning to either decrease or cease altogether. On Thursday, a day after that Jerome Powell speech from the Fed, the market started to process the fact that 75 basis point hike could still be on the cards. And there were some other prominent figures in the Federal Reserve who said that this could be on the table. I personally don't think that they are going to increase the rate in the next couple of months by 75 basis points in a future meeting. However, this has been priced in slightly to the market. And what you see this kind of fear that they're going to increase those rates much higher than had previously been expected. But just like during really strong economic times and when there's a really strong bull market, we then start to see people having too much enthusiasm, getting very euphoric. The same thing kind of happens on the downside. So when there's a lot of fear in the market, people start to fear that the interest rates are going to increase. We will not have control over inflation. There's going to be a recession. And this causes a lot of fear in the market and causes stock prices to go down. So it can work both ways. I think it's very important that you keep a level-headed mind and you think in probabilities and you think what is the most likely to happen, and then you manage your risk accordingly. You don't want to make any drastic decisions either when you're euphoric or when there's a lot of fear in the market. You want to increase or decrease your risk, and you want to make sure that you're in the market for the long term. On the flip side of that, we've also seen a really strong employment market. And a lot of the data that was released is actually showing that wages are going up quite significantly. And what we actually saw is the labor costs actually increase by 11.5% in Q1. And that was against consensus estimates of 9.5% for the first quarter. So it's just showing that there's a lot of jobs in the market. It's a very strong and buoyant market. However, this is going to have an effect on businesses that require to pay a large amount of salary costs. So it could have an effect on some of the bottom line. We've also seen commodity prices increase quite a lot this week. This was good for some of our stocks such as Chevron. I also did a lot of natural gas trades last week in the short term. Natural gas hit an all-time high again last week, and I managed to short that quite successfully. And towards the end of the week, there was quite a lot of weakness. So I did a lot of profitable natural gas trades last week. Also, we have seen oil prices hit a very high level, and now it's at about $109 a barrel. So as we move on to Europe now, and again, last week for European stocks, it was a very tough week with most of the major indexes losing ground last week. And this was again mainly to do with efforts from governments around Europe in order to try to curb inflation, but obviously at the detriment of future growth in their economies. So last week, what happened in Europe? Well, there has been ongoing discussions by European nations and the EU last week in which they plan to place an embargo on Russian oil and reduce their dependency over time. And the plan is to do that over the next 6 months or so. However, there was some pushback from some European nations such as the Czech Republic and Hungary, who have a very strong dependence on Russian oil. And it looks like there could be some things that are actually introduced by the EU in which allows Hungary and Czech to reduce that dependency more slowly than the other European nations in order to stop an energy shortage. Last week, we also saw the Bank of England raise their interest rates again by another 25 basis points, which takes the amount of increases so far this year up to about 1% rise in interest rates. And this is the highest rate that interest rates have been at since 2009. However, they did decide to reduce the stockpiling of buying bonds over the next kind of couple of months in order to be able to keep that economy a little bit more buoyant and not cause a short, sharp shock to the economy. And in economic data from Europe, we also did see that German manufacturing sector had reduced through the last quarter. And this just shows that there had been a lot of concerns in the economy about slowing growth, but also some of the issues that we had with coronavirus a little bit earlier in the year and also at the end of 2021. So this had ongoing pressing concerns for the German manufacturing sector. As we move on to China now, and last week again we saw more difficulties in the Chinese spluttering economy. And one of the main reasons for that is to do with those lockdowns that we've seen in China since around the 28th of March 2022, when Shanghai went into lockdown. Although some of those restrictions have been reduced, the city of about 25 million people is generally still under lockdown. And what the Chinese government have said is that by reducing the protocols and the lockdown restrictions in China, this would inevitably lead to more cases of COVID and potential death. So it's quite obvious that China is making sure that it protects its citizens over the economic implications of having these lockdowns for longer periods of time. So I think that they're going to continue to look at the data and they're going to keep those lockdown restrictions in place until they see a real drop off in the number of cases. And this is clearly having an effect on the economy. If we look at the latest Labor Day holiday statistics, which is a big national holiday in China, and what we actually saw is sales during that Labor Day period actually reduced by about 43% on a year-on-year basis. So obviously, because of those lockdowns, people are spending a lot less money and it's having an overall impact on the Chinese economy. Hopefully, they won't be locked down for much longer. And then once that does recover, hopefully we will then see an increase again in the Chinese economy and some of the normal sectors will start to go back to some type of normality. Also in China, we have continued to see these ongoing increasing tensions with the US. As I've said in many of my videos before, that there is a lot of tension around Chinese companies listed in the US, in which the US want to have a lot more transparency around the auditing of Chinese companies listed in the US. And what they have done is they've added another 60 Chinese listed companies in the US to that list, in which they expect them to meet those guidelines of listing in the US before the 2023 cutoff period. To continue with that theme, the Chinese government have also asked all state-owned and government and local Chinese companies to also switch their computer systems and their laptops to Chinese-made technology and to remove all of their foreign laptops, computers and equipment over the next 1 year. And this is a clear sign that they want to move towards Chinese technology and that they do not want the US to have technical data of Chinese citizens and potentially Chinese government secret. As we move on to the top 3 performing stocks of last week, and the top performing stock of last week was 𝗱𝗲𝗄𝐶, which was up about 27.5% overall for the week. And that is because they had a very good earnings report. It was also reported that they got FDA approval for one of their key drugs as well. So this caused the stock to rise last week. The second best performing stock of last week was Chevron, which was up about 8.95% last week, which is not a surprise because the oil price rose quite significantly last week and actually went up to about $109 a barrel. The third best performing stock for last week was Cigna, which is an insurance company in our portfolio, and that was up about 8.7% for last week, and that was mainly due to a really good earnings report that they delivered last week, which we saw some really positive financial data and progress overall from the company. So now let's talk about crypto. And again, last week was a very difficult week overall for the crypto market, and it has been a difficult 2022 so far. And that is mainly because, as I've said previously, we are in a risk-off type of environment, especially with the Federal Reserve increasing those interest rates. It's leading to a lot of investors being kind of risk-off and looking at defensive assets rather than growth assets such as crypto, but also technology stocks as well. And it's been very difficult now that it has actually fallen below that $36,000 level. However, there have been a lot of continued buys and a lot of buying pressure from the Terra Foundation, who actually bought another $1.5 billion worth of Bitcoin. And we have also seen those MicroStrategy buys very regularly as well, which I think are really holding up that market. And it might seem that we've dropped quite a lot in terms of crypto, but I actually think Bitcoin has actually held up pretty well if we look at other assets such as kind of growth stocks. So it's something to keep an eye on. But I think what's mainly happening at the moment is I think that a lot of those short-term speculators that came into the market in 2020, 2021, who have made kind of either a lot of gains and taken profit, or alternatively, they have bought, near the top, as a lot of retail buyers have done, and they've held on for a little while, and then they've started to sell off the crypto and the Bitcoin. And they've kind of come out of the market because they've either lost money or they've got bored, which happens really in every single cycle. However, we have continued to see the long-term hodlers and those kind of crypto native people seeing this as an opportunity to increase the amount that they invest in their crypto holdings. So we are hopefully should start to see a floor in the crypto prices generally overall. And I don't expect Bitcoin really to go below $30,000 mark. And I think one of the main reasons for that is obviously we know that Bitcoin moves in cycles with the 4-year halving cycles. And at the very top of the market in 2017, right at the end of 2017, we saw Bitcoin peak at about 20,000. And it's very unlikely that Bitcoin would ever go below that level, and it hasn't done throughout its history of halving cycles, gone below the previous high of the cycle before. So I don't expect Bitcoin to go to that levels. I think it will actually, it should actually stick to about 30,000. It could go slightly below it for short periods of time, but the lower it goes, then you expect a much bigger spring back overall in the price. If you think of Bitcoin just like as a coil, and when the price is going down, it starts to contract, and then when you start to get to below those $30,000 levels, then the pressure continues to increase, and then that's when you start to see that kind of shooting up of price as you have this continued amount of demand. We did see some positive news in terms of developments in crypto last week, however, and we did see an approval of the 𝗲𝗂𝗂𝗃𝗃 Bitcoin futures ETF, which was approved last week. Again, it always seems to be these futures ETFs that have been approved rather than a spot ETF, which everybody has been desiring. And I think the next one up for either approval or rejection in terms of the spot ETFs is the Grayscale ETF, which should be either approved or denied sometime in the summer. So that is something that we need to keep our eye on. We also saw some more positive news again from countries which are really starting to embrace Bitcoin. So this country was Uzbekistan, who last week have actually stated that they're going to exempt individuals and crypto related companies from income tax. And again, this comes on the back of the news over the last couple of weeks that Central Republic of Africa is going to have Bitcoin as legal tender again. And obviously that was on the back of the El Salvador news last year, in which it became legal tender in the country. So we're seeing some really positive steps from some of these countries, and it really adds more legitimacy overall to the Bitcoin ecosystem. And also it was announced last week that Algorand, a very popular protocol, has got the sponsorship rights for the lead blockchain sponsor at the Qatar World Cup coming up next year. So this is very positive overall for both crypto and shows a lot of exposure again to these crypto related companies, and it makes sure that the mainstream people start to see what is happening in the crypto markets. Also, it was announced last week that Binance, which is one of the largest crypto exchanges in the world, has actually pledged that it's going to commit $500 million to help Elon Musk with the overall purchase of Twitter. I think that this is a very positive sign, not only for Twitter, but also for crypto as a whole, because Twitter is often used as a community-based group for crypto people to discuss, also to promote crypto projects, and generally is very positive overall for the ecosystem of crypto. I know that the last couple of months have been incredibly difficult for you in the market. It's been difficult for everyone. We have seen unprecedented things that have happened in the market this year. We've seen increased interest rates. We've seen supply chain issues. We've seen a war between Russia and Ukraine. We saw outbreaks of COVID in certain countries. This has all put pressure overall on the economy. However, it doesn't mean that this is going to be ongoing for a long time. And we do see periods like this sometimes in the market when there is increased pressure. As I've said before, what you see often is you see people getting very euphoric during those good times in 2020, 2021, and you think that it can go on forever. However, there are hiccups in the economy. It's really important that you think long term and not get too low when you're losing right now. I think majority of people in the market are losing money at the moment, but make sure that you are in it for the long run. And don't really try to time the market. I think a dollar cost averaging approach is the best in these situations. Right now, you are getting opportunities to buy stocks, and you're also getting opportunities to buy crypto at very low levels. And I think in the future, by adding at these points, I think that you're going to not regret it over the next couple of years in the future. We don't know when the lows are going to be, and we don't need to predict when the low is going to be. I think there's a lot of emphasis in the market that people need to be able to call when the lows are going to be, and they need to be able to sell at the very top price during the good times. What's important is managing your risk, and then, starting to sell your stocks or your assets on strength, and then you buy quite aggressively during weakness. And generally over time, this is going to produce very good results. There may be some volatility in between, and it's important that you invest money that you don't need in the short term, because if you need that money in the short term, then you are really a hostage to what's happening in the market, and you may be forced to sell at an inopportune time. So please stay patient. I think I have a very strong strategy. I understand that my portfolio is down for this year, But if we look at this over a long time period, my portfolio has done incredibly well over the last 5 years, and I expect it to do well again in the future. And we have to ride through some of those volatile times in order to experience the good times. Thanks very much for listening to my video today, and don't forget to please join my Discord group if you haven't already. We are very regularly having discussions. It's especially pretty good at the moment for those discussions because there's obviously a lot of fear in the market. So it's good to talk with like-minded investors who are in the same shoes as you. I also plan over the next week or so to do a kind of a presentation type video, which I want to explain a bit more in detail about what's happening in the markets, and not so much news, but I want to go over some different charts with you and explain more about the specific elements of the economy and what I expect to kind of play out for the rest of the year. So have a nice week ahead, and let's hope for a much better week.